right, let me bring on board Trideep Bhattacharya. He's President and CIO Equities at Edelweiss AMC, joining us this morning. Trideep, very good having you. Let me first start off by how you're assessing the earnings print for Q4 and what is it that you would see in terms of risks for FY27 based on the commentary? Would there be a sector pocket you'd be concerned about?
Good morning. Thanks for having me on your show.
Great having you.
I would say that, the numbers, actually, if you look at the numbers so far for the last quarter result season, they have been fairly robust. They go on to show that we entered into this West Asia conflict in fairly good shape. Outlook was a little clouded, so to speak, and I see an earnings cut of somewhere around 2 to 4% at Nifty or broader market levels for FY27. I think that's fair. That assumes that we will, by and large, resolve the major outstanding variables, which include oil north of $100, etc., by the June quarter, which seems to be in play. I think the market is kind of, at the moment, grappling with or looking to factor in that fundamentals, particularly in the month of June, will get worse before it gets better. And that's the reason you are seeing the market reaction the way it is in the near term. But I think it's part of adjustment, near-term, short-term adjustment, rather than anything to get worried about the meeting.
Okay, and therefore, maybe light at the end of the tunnel, Q1 FY27, will that be probably the toughest quarter to deal with for corporate India?
Yes, I think, that's what I meant when I say fundamentals will get worse before it get better. The June month would be the first month where, the economy will feel the impact of higher fuel prices, also a slightly late monsoon, and the likes of it. So all of this, and this is probably one important month for the whole April, May, June quarter, and hence the June quarter numbers, which in my opinion will see the worst of the West Asia conflict in terms of financial impact. There could be a bit of spillover into September quarter as well, but that's where we are right now. This, of course, assuming that we don't resume fights or we don't resume a fresh round of aggression on the political front. But based on things as they stand, June quarter would probably see the worst impact of the West Asia conflict.
How much of that is already built in, Trideep, in your opinion, into stock prices?
Yeah, so that's why I was saying that overall, if you look at the earnings cut, has been somewhere to the tune of about 2 to 5%. The markets from peak are down about 5 to 10%. Broader markets, some of the stocks might be more than that. That goes on to show that quite a bit of this is factored in at a market level. There could be stocks where there is a bit of mispricing, which are corrected during the result season. So I think the June quarter weakness is by and large understood. Any weakness on top of that is something that we need to sort of, incrementally think about, worry about. If we get into the September quarter earnings and that also turns out to be weak, then that's something which is not factored in. But otherwise, as we speak, as markets at current levels, broadly factor in a weak June quarter.
Okay. And with regard to sectors, Trideep, let's dive a little bit deeper there. This kind of rally that we've seen on the Nifty IT index, it's very healthy. I see you have low to no IT holdings. It's very clear as to where you stack up in terms of, how you see IT. But give us a sense, am I right in assuming that probably IT is something you're staying away from? And if so, wouldn't you believe that comments coming in from Jensen Huang, etc., give some bit of a cushion with regard to possibly how IT or Indian IT could play its role in the global AI wave that's coming at us?
I have to correct myself. I think we are underweight IT, but we do have a good proportion of our portfolio in IT. Maybe we are underweight by about 1.5%. We are not in the extremist bear camp where who feels that IT services is done and dusted. We think that certainly in the first wave of AI, which is more hardware, more infrastructure-led, IT services is missing. But as it gets to a more deployment stage, IT services will play a part, and Indian IT services will sort of come handy in that standpoint. And what we are going through is a bit of a transition, particularly in risk-off phases of the market, like you are seeing right now. IT tends to do well, but that's more seen as a defensive more than anything else. But I do think that overall, this adjustment phase is about 4 to 6 quarters. But once that comes through, I think you will see IT also come to do well. Within IT, we are positioned, of course, more towards mid-cap names, which have continued to maintain their growth trajectory by and large, despite the AI headwind. And we think that's a decent place to be.
Okay. And with regard to AI, how do you expect things to develop within that IT industry as a whole? Do you expect revenue compression? Do you expect that growth, though, especially from new projects, will accelerate? Fixed cost contracts will go up? What's the trend or the thesis there?
Sure. So I think the first thing that we need to understand is this whole AI is another tech wave which the industry is dealing with. We have dealt with multiple sort of tech wins before, tech waves before, like Y2K, like package implementation, like cloud, etc. This is one more in that context. The first wave of any tech wave is more hardware-led, and that's why these IT services guys are not present, and hence they are taking a knock. But as it gets into more enterprise adoption phase, you will see that software and services start to become important, and that's where services come in. So they will have a role to play in AI is the first point that I would make. Second, in terms of the compression of the work, what used to be done by 10 people before, with the use of AI, would be maybe they need about 7 people in total. But the scope of the work would stand to expand meaningfully over a period of time because there are multiple new areas of work that might actually come in. It's this mix between the lower work per unit of work and the incremental work which the industry is calibrating in this process. And this is this transition that I was saying is about 4 to 5 quarters transition, which will need to happen overall. So, at the moment, growth rates, if you look at the AI percentage, are somewhere about 5 to 10% of their sales. This, I think, will actually go higher over a period of time. It'll cannibalize on the application development management part of their revenues. But overall, this transition, once that happens, will again bring to bear the fact that services ultimately would be needed to stitch any software package like that of AI onto the prices that are looking to adopt AI over a period of time.
Okay. And Trideep, just with regard to markets currently, what's the lowest hanging fruit for you? Most people or most fund managers like yourself look at private sector banks extremely attractively. How should one look at probably the most attractive segments of the market right now? What would feature in your opinion?
I think the two trends I would put in front of you. One is that the credit growth has bottomed out at about 8 to 10% September, October last year, will likely space out to about 14 to 20% over the next 6 to 12 months. And clearly, private sector banks or financials as a function of that would actually stand to do well. But I think the second part also is that after going through this West Asia conflict, we realized that we can't have 70 to 80% of our imports coming through one Strait of Hormuz. So clearly, over a period of time, energy security, energy independence is a big theme in my opinion over the next 4 to 5 years that will come out. That combined with post-war reconstruction are the areas that we are hunting, are the places where we are hunting for new ideas at this point in time.
Okay, so probably those two areas is something we need to look at. What do you make of cap goods? Because that also, in terms of your overall portfolio, is a large chunk. How are you playing that theme? And do you continue to be constructive with regard to this theme even now?
Of course, we need to find valuations where we are comfortable to get into the stocks, but as a space, energy security, renewables, and companies that supply nuts and bolts onto this energy security as a theme are the places to be, and they happen to be in capital goods. And hence a good part of our portfolios are in capital goods. Some of them have run up quite well. We occasionally take profits, but we wait for declines to kind of increase our holdings. But directionally, we will continue to remain positive on this theme, particularly over the next 3 to 5 years. Imagine if the energy infrastructure that has been destroyed as part of this West Asia conflict takes about 3 to 5 years to actually build. The companies will participate in making this happen would have their order books sooner or later kind of in a fairly robust manner. So we need to wait through that time, and then the better numbers will stand to flow out.
Okay. And Trideep, how should one look at some of the other pockets which have actually done very well? Metals, defense, and the like. How are you looking at those pockets?
Defense is a consensus theme. We are also positive. We are mindful of that there are fairly new, small listed companies. They tend to get fairly expensive fairly soon. So we wait for pockets of macroeconomic stability, and they start becoming a little cheaper and use those declines to build on. But that's a second area that we are positive on in our portfolios. We also like the hospital space. We think that at a level of penetration, we think the hospitals is a fairly underpenetrated category in the context of India, and over time have significant role for expansion. So that's the other area that we are overweight. And as I say all of these things, I'm sure you realize that a lot of these ideas actually fall in the mid or the small cap domain, which is why we think that that space is a fairly diverse and attractive space, which has sectors which are gaining market share in the context of Indian economy. And hence we have been positive on this space for a good while. And it's kind of gradually looking up in numbers as well.
Right. And anything that you're cautious about at this point of time, Trideep, staying away from?
Mass consumption. I think in the very near term, I do see that, as I was saying, in the month of June, we will brace for the impact of higher inflation. And I think coupled with a slightly delayed monsoon, mass consumption will probably face the heat in the near term. And hence, we would be underweight in some of those segments. Overall, luxury consumption will continue to remain as a long-term theme overall. But mass consumption is the place that we are careful about. We're also careful about telecoms. We think that a good bit of price increase has already happened. So we need to be careful from that standpoint as well. So those would be two areas where I would point out we are underweight in our portfolios.
Trideep, what really stood out in earnings? A very decent set of numbers coming in from the paints counters. A decent set of numbers from, for example, some of the plywood counters. Are real estate ancillaries starting to see a pickup in your opinion? The commentary was constructive, margins are better, pricing is getting better as well. Or do you believe that there are some near-term headwinds to this story? Because crude obviously is expensive and that's negative with regard to paints, and obviously the entire supply chain globally is also impacted, which could impact plywood as well. What's the sense that you're getting?
Sure. A little less macro. I would say that industry dynamics are at play for these sectors. So in paints, one of the players who was recent entrant over the last couple of years has been fairly aggressive, and is now the aggression is gradually cooling away. So to that extent, there is a bit of stability in the industry, and hence the leader started getting back onto volume growth trajectory. It's kind of the industry adjustment is the way I would point out. Plywood, again, has been suffering from MDF capacity coming on a great way. And that capacity finally stabilizing is also giving a bit of better numbers, so to speak, coming through. So not really very high macro, but industry-specific dynamics are making some of these segments show better numbers over a period of time. We need to see the industry adjust to this and then take a sectoral call rather than being very carried away by 1 or 2 quarter results.
Okay. And what about auto? The numbers continue to trickle through. They continue to remain quite positive, right? Resilient.
So autos, that's something that we've been quite positive for a good part of last 1.5 years. And I think that's played out quite well. Incrementally, though, I do think that, as we get towards the back half, the base gets a little larger. Given that there are a couple of near-term headwinds coming about on consumption, we, particularly on the OEM side, we are a little careful, probably neutral rather than overweight at this point in time. We think the is kind of factored in a good bit of the share prices. We're more stock specific and selective in those comments.
Okay. All right. Trideep, thank you so much for joining us, giving us that perspective, that view. Always good having you, of course. And, it's good to kind of contextualize everything that's playing out, take a bit of a step back, ignoring all the noise that's playing out in markets today.
Thank you.
Thank you so much.